Hello guys, how are you going? Welcome back to another collaborative video here. We find it quite hard to schedule in these videos, and when we do schedule the videos in, sometimes we'll be halfway through a call, which has happened twice now, and trading alerts go off, and we obviously have,
Guilty.
both full-time traders, and so we need to kind of dip out and enter those trades, see what's going on with them, of course, because that's the income, that's how we make the money. And so we're back though, and we're sure third time's a charm, as well just said before we started filming. Maybe this time will work out without interruption. Let's see what happens.
Okay, let's get into it. So Wolf, we're going to talk about the macro today. Is that correct?
That's correct. Yes.
We're going to get into it, and I think a lot of people are very confused right now. I think a lot of people are kind of this bull versus bear mentality, and I want to talk about that later in this video again. But this bull versus bear mentality is exacerbated at these major points of resistance. And the reason being is because people tend to get overly bullish at resistance before resistance is broken. And Wolf will talk about that in the video later on. But we're going to talk about first and foremost a few things. And that is number one, this major horizontal resistance zone. And I'm going to go ahead and screen share.
Well, do you want to just share your screen?
Got you covered, Wolf. We'll go ahead and screen share because that was a problem for our last video. I completely forgot to screen share. But you can see this now, Wolf.
Yep, correct.
Awesome. Okay. So the horizontal resistance zone, which we see over here, which is this major trigger level. We'll talk about that in this video. But we're going to first foremost talk about, is the bottom in? And this is a question almost everyone in the market is trying to answer, if not already given some sort of answer to. And it feels like every second Tom has an opinion on where the bottom is, why the bottom's where, and we're going to talk about, our opinions today in this, and more or less re-emphasize what happens next. Because for myself, I've already given that prediction. I've already talked about that. It's past tense. My prediction was over here on its 9-year trend line, 18K. It's past tense, it's up 30%. Wolf will talk about his, and he's going to discuss, I guess, how his is actually quite similar to mine, just has different confirmation points. So first and foremost, guys, 200-day moving average, and the 200-day moving average, the moving average is in fact just an average price over a specific number of periods. So it's not a resistance, it's not a support. What it is, it's a signal of strength. So when the price is over the 200-day moving average, we can assume that within the period or periods of which the candles are over the 200-day moving average, those periods are showing significantly more strength in comparison to when the periods or the candles are below the 200. So we have this shift in strength in the market, and generally that shift in strength is defined as a trend. So we got this strong uptrend versus this stronger downtrend. And the bigger the moving average, the slower the moving average, the stronger that is. So what has changed now that we're broken the 200-day moving average? So we were talking about this earlier, Wolf, and I think I'll just go ahead and bring it in a second. But my personal opinion is that the bottom was in fact in here until proven otherwise. And proven otherwise is meaning we lose this level again, okay? And the probability that we do go down here and lose this level has been drastically decreased ever since we closed that weekly above the 200. So the fact that we've closed on a weekly above the 200 has not said, we can't go to new lows, but what it has done is reduce the probability that we do go to new lows. Wolf, what do you think about that?
So that's interesting what you said there. I think this is how we basically, this is completely coincidental. I wasn't planning this, but this is probably the best summary of the difference between our opinions right now, right? So both of us think the macro support line is very worth considering. But the biggest difference is this. You said the bottom is in your opinion, until proven otherwise. I would say the bottom isn't in until proven otherwise. I think that's probably the best way you're ever going to get to sum up the differences between our opinions. What do you think about that?
I 100% agree. And that doesn't mean we have different opinions. What it means at the end of the day, like we said, we have different validations. And
yes,
our validations aren't based on different technical analysis or different skill or different knowledge or different opinions or whatever. It's based on our risk tolerance. And risk tolerance is subjective. My risk tolerance is a little higher. I'm more risk averse than Wolf. That doesn't mean my analysis is different. It just means I'm willing to take more risk at certain levels than Wolf was. That's all it means. And that's what's happened. Wolf, keep going. That was good. That was a good point.
Yeah, so yeah, that was the main point. And then also, as per the 200-week estimate, now this is an interesting one, right? Because like I obviously have put a lot of weight on the 200-week SMA in the past. There's no doubt about that. In fact, my initial predictions from November last year was we would bottom out of a 200-week SMA. And the reason I did that is because of the saying, invest with your trend until it ends. And the trend was we bottom out on 200-week SMA. Now, that was my original prediction. That was obviously invalidated. Before it happened, I think at 30K, I said we'll probably lose it. But give it, that's just an example of how much weight I've put on it in the past. Now, we've closed above the 200-week SMA. You're correct, 100% correct, and I agree with it. This has reduced the probability that there would be a new bottom on Bitcoin, right? We've closed above 200-week SMA. Obviously, it's bullish. It's not bearish. So what else is it? But I would say still, and I think you'd agree, it's not enough at all. In fact, I wouldn't even say it's very close to confirm, the bottom being in. I think we need to take higher levels. For example, we need to take 23.8K, and I think more importantly, we need to take 28.6K for the ultimate confirmation of that bottom being in. Now, I'm going to go ahead and share my screen for a second. So if you want to... Okay, so as we can see here, and as I just explained before, we can look at a few things and what I deem to be the relevant confirmation zone that the bottom is in. Because as I said before, I am assuming that the bottom isn't in until proven otherwise. Why am I doing this? It's not because I don't think it's likely that the bottom is in. It's because simply I'm a breakout trader by nature, right? And and in the same way, I'm a macro breakout trader. And so I'm waiting for the breakout, of course. And so what I would say is that what we need to be doing in the short term is breaking above 23.8K. If we break above 23.8K, we would have a clean shot towards 28.6K, and 28.6K, in my opinion, would be the confirmation that the bottom is in. If we break above 28.6K, we're effectively breaking above the neckline of the entire bull market structure back from late 2020 and the entirety of 2021, and even in the start of 2022. That, in my opinion, would be enough to confirm definitively that the bottom is in fact in on Bitcoin, and that would be enough, in fact, to confirm that the macro bear market structure is over. Now, why do I think that we would jump so rapidly from 23.8 to 28.6? Simply because we don't have any historical price action at all, really, besides a week and a half between 23.8K and 28.6. And as you guys would know, basically resistance, one of the main ways resistance is actually built is through historical price action in that region. There's nothing there, so I think it would be a swift jump. So just to clarify before Whale can jump back in, I think that breaking above 23.8K would lead us to be short-term bullish, and then 28.6K would be the final test. That's what I think about Bitcoin right now. And I will say, you asked me a question about the 200-week SMA. I don't know if I answered it fully. The reason why I'm not willing to be super considerate of the fact that this break above 200-week SMA is extremely bullish is because, well, one reason is the volume profile, right? The volume profile is telling us that in order to achieve this big run up to 28.6K, we need to break 23.8. And so 23.8, in my opinion, would be more important. And we have actually dropped below, for example, COVID, for example, back here in 2015, we've closed below this thing before without having a follow through. And so I think there is a chance that we can close above it like we've just done without having a follow through as well. So I'm looking at other levels as more important. What do you think about that?
Well, it goes back to the same thing with really that, like, it doesn't matter. Sorry, it does just clear my throat. It doesn't matter if we go back below 200 because the 200 is irrelevant because it's not a support or resistance, in my opinion. What matters is that we remain above that previous low, which I call the bottom. That's all that matters to me. If we go back to this chart over here, you can see on my screen that this is my initial prediction. 11th of July over here, we see 18K. You can see it on my screen over here, it reached that. So if we go up, down, sideways, we go all over the shop, I don't really care if we go back below the 200. What my whole statement is, if we do have a close above the 200, which we have, all it's done is to significantly reduce the probability that we lose this 17,500 18K level again. Meaning that the fact that we have closed above this has increased the probability that this prediction was correct, and that's all that matters to me. I have no interest. I don't really care. It doesn't bother me at all. In my eyes, that's worked out. Now we 100% agree on everything else. Break over 23,800, we'll see a move upwards, and that's the VRPV shows that. Historical price action shows us a very low resistance range. We actually won't even need much volume to get through that range. What we do need volume right now is to get between, or to get up to and break over 23,800. That's a very sticky zone on the chart, a zone of significant resistance, which we can see. And if we go to hourly, Wolf, I'm so sorry you're not able to see this because I'm not screen sharing, but I'm recording. I'm going to go ahead and screen share this with you real quickly.
Yep.
Let me just go ahead and screen share this. But everyone else, you should have been able to see that then. Let me go ahead and bring this up. We can see that we do have, this falling wedge formation, which is kind of going over like sideways through this horizontal resistance. This resistance is at 22,800 to 23,800, which Wolf just talked about. And we will need a break above 23,800, and I would expect a daily candle above that to confirm that we have actually broken above, and that will take us up to 26,500 and 28,000. Now, another question that I guess everyone is asking is, just because the bottom is in, or well, I think it is, just because the bottom is potentially in, does that mean we're in a bull market? And the answer to that is no. We are still in a bear market. We are still in a macro downtrend. As long as we remain in this pattern, we are in a macro downtrend. Wolf, I know you agree with that. I'm not even going to ask. I know you agree with that. We've talked about this already. We are in a macro downtrend. We are in a bear market as long as we're in this pattern. And if we do break above here, so 28K, maybe even a little bit higher, this downwards resistance zone over here, we will see a confirmation that we've flipped the bear market, meaning we're no longer in a bear market. Again, that doesn't mean we're in a bull market. It just means we're no longer in a bear market. For us to be in a bull market, we need to get above 48K. That's confirmation of the bull market. If we get above here, we are in a strong uptrend. A strong uptrend, okay? We have major resistances still to fight along that way. I think I just wanted to clarify that. Another thing I want to talk about, and we'll feel free to jump in on this, because I know you love to talk about market psychology. That's kind of one of your things. Not so much mine. I care more about the individual psychological aspects of trading rather than the collective community. But the bull versus bear mentality, and I want to talk about this, because it's a very toxic mentality, and it's actually more detrimental to your individual profits than you're probably aware of. And I think it becomes very, very, it becomes a big thing in the market. Almost everyone's like, I'm a bull, I'm a bear, you're a bull, you're this, you're that. Who cares? At the end of the day, it doesn't matter. What matters is the trend. What matters is that you've identified it and you're trading the trend. You can be bearish and still buy longs.
Yes.
You can be bullish and still buy shorts. And what I mean by that is you can be macro bearish and still expect the price to rise on the short term. That doesn't make you a bull. That just means you're trading the bounce. That's all it means. And I think it's very important, like myself, when anyone calls me, like for example, when I posted this chart, everyone was calling me a perma bull, I'm an idiot, the price is going to go to 100K, blah, 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 blah. I didn't listen, I didn't care. Because I don't identify as a bull or a bear. I identify as a trader. I just trade the trend. Wolf's the same. Anyone calling Wolf a bull, anyone calling Wolf a bear, all you're doing is you're imposing your own personal views on someone. Because myself, I'm not a bear, I'm not a bull. Wolf, he's not a bear, he's not a bull. We're just trading the trend. We don't care.
Yeah, we don't care. This is what we were talking about before, right? We said before, sorry to interrupt. We said before, if we didn't have YouTube channels, right? We're traders. If we didn't have YouTube channels, we genuinely wouldn't care where Bitcoin bottoms out or when it bottoms out. It does not affect us. All that affects us is understanding whether we are in a macro bullish trend or a macro bearish trend. Then we can alter our personal trading strategies based on that. But where Bitcoin bottoms, mate, I couldn't care less where Bitcoin bottoms. I'm not going to buy the bottom. I don't care. I might buy a little bit. I might buy a little bit for my long-term bag, but the vast majority of the money I make in this market is through trading. So I think, identifying, and a lot of people in the comment section, not saying my core community, I'm saying outsiders, right? They'll be like, oh, bull, bear, oh, you're bad because you're a bear, or you're bad before. It's like, it does not even bother me in the slightest. It does not affect how much money I make. It does not affect how much money my VIPs make, which is where the trading happens. So why should I care? I think identifying yourself as a bull or a bear, all it does is kind of put you in a red jersey or a blue jersey. It's like, this is my team, that's the enemy team. And once you've identified that team mentality, all you're going to want to do is beat the other team. So you're going to block out all the relevant information on the other side, because now you're in a team, right? You can't betray your team. And it just leads to you losing money. I think it's completely irrational. Yeah.
100% what we see. And we see a lot more of that at the top and the bottoms. At the top, at 60K, when I flipped bearish and I was saying we're going down, and you flipped bearish and you were saying we're going down, we had people yelling at us for weeks, and that didn't really stop until we rejected at 48K. It didn't really stop. Then more people started to turn bearish. And I had the same thing. People calling me an idiot that I was bullish at the bottom. I'm up 33%. Do you think I care what those people say? No. I think, like Wolf just summarized perfectly, if you got the bear or bull mentality, all you are doing is you're cutting yourself off from the other 50% of information that you can actually utilize to benefit yourself. That's all you're doing.
Yep.
If you're going to sit there and be like, you're a perma bear, blah, 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 because the price has gone up 20%, at the end of the day, that exact mentality is exactly the reason why you are down right now in the market.
Correct.
Simple as that.
Yeah.
There's nothing more to it. And I think people really need to snap out of it. A lot of people in my VIP, my community, have come to that realization over the last few months. And, just because you've lost money in the last few months doesn't mean you're a bad trader. A lot of people have lost money in the last few months. But what does mean you're bad is if you haven't identified the causes of those losses and tried to actually make a change from your strategy and your psychological, triggers to actually help benefit you. I think that's kind of all I wanted to talk about right now. There's a bunch of other things, but I think we'll go into bond yields next, and what else?
Yeah, I can start discussing bond yields, and then you can jump in for sure.
Well, I think
share my screen.
Let me just. I reckon maybe I should start with this. I think a lot of people on this channel might not even know what a bond is.
Oh, sure, go.
And then maybe you can talk about, because I think we talked previously. You wanted to talk about the correlation between the bond yields and inflation right now, was it?
Interest rates and inflation, yes.
Interest rates, yeah, cool. So I'm just going to go ahead and talk about bond yields and bonds, just so everyone's got a little bit of a base understanding before Wolf talks about that, just so we're all on the same page here, no one's left in the dark, we all know what's going on. So let me go up over here, and I draw a little diagram before to talk about bond yields, what a bond is, how it works, and how they relate to the dollar. So essentially a bond, guys, is an IOU, and it's issued by an entity when someone needs money. So if I go to Wolf and say, hey, Wolf, can you give me $10,000? He's like, sure. And I write out IOU, like I owe you $10,000. That itself is the bond. So a government bond is kind of what we're talking about in financial markets. We use government bonds, but those can kind of relate, show an inverse correlation to how the dollar moves, so the strength of the dollar. So a government bond is basically when the government has borrowed money from another entity, a private entity, and these bonds last until maturity. And the maturity time on bonds, they can range. Today we're going to be taking a look at 10-year maturity bonds, so 10-year bonds. These meaning after 10 years, their capital amount or the principal amount is paid out at maturity in full. Now, a bond yield is essentially the rate of return that the person gets with the bond at specific increments throughout the maturity or the life cycle. So maybe every year they get like a certain percentage, right? That percentage, that return percentage is the yield. All right, okay? So the yield serves as an indicator for strength of the stock market. And obviously we know stock market is correlated to cryptocurrency market. So it also serves as an indication for the strength of the cryptocurrency market. Okay. So we have over here, we have rising bond price equals decreasing bond yield. Okay. Rising bond yield equals decreasing bond price. Okay. So the yield starts decreasing. We see the dollar start, if the yield starts decreasing, we see money flow back into assets. Okay, so we're going to go ahead and talk about this over here. So this is our bond yields over here. Okay, our 10-year government bonds, our bond yield, we can see that we're starting to decrease on here. Okay, that is reflected by the fact that the DXY is also falling. Okay, and what does that mean? Well, that means money is flowing from cash into assets, and that is one of the main reasons why we've seen, the financial markets, including the cryptocurrency market, start moving up. I think that explained the basis pretty well. Wolf, I'll let you jump in and talk about what you want to talk about, and I'll come back to that in a sec.
No worries. All right. So broader speaking, right? So this is what I brought up in my video yesterday. I don't know if you guys have watched it or not, but essentially what I said is that I think one of the best chances, and this is a given, by the way, this isn't necessarily an opinion, it's kind of just objectively true. One of the best chances that Bitcoin has to break 28.6K or even 23.8K, which is what we determined before to be critical levels, is if the traditional markets, and obviously as per systemic risk, etc., like Whale explains, if they continue going upwards, right? So it all goes hand in hand. Crypto, traditional markets, they're separate, they're both connected to the systemic risk. But if that systemic risk continues decreasing, stocks and crypto will both go up. But the thing is, the traditional market, in my opinion, gives us a better indicator of where and the systemic risk lies. I can't say that word very well. And so, as you just said, bond yields are going down, DXY is decreasing, and so we're getting an indication that, hey, either this is just a little bump on the way down, or this is actually a reversal point. And there's something that we as market participants maybe don't know as well as the market makers do know, right? Another thing worth kind of saying is that the S&P 500, for example, just one example here, and the traditional markets as a whole, they will react to things before they happen. Okay, so for example, interest rates going up is kind of the thing that led to this whole situation we've got ourselves into, right? Of course. And that's also because of inflation, etc. But interest rates is the big deal. It's like when they started raising interest rates, everyone was getting scared, okay? But the S&P 500 started dropping before that even happened. And so it is reasonable to say the S&P 500, hence Bitcoin, hence everything else, will bottom out before the macro situation starts to look good again. And so, hey, maybe the systemic risk has decreased massively. And that's reflected in things like, for example, gasoline prices, which are dropping massively. There are indicators that could be the case. And hence, if that situation does continue getting better, and we'll start to know that when things like CPI comes out in 7 days, that's a massive reason to be bullish again. Another thing that I would think is slightly bullish is the fact that everyone's kind of expecting interest rates to keep increasing, and yes, they probably will keep increasing, and there's no argument to be made against that, really. I mean, we can't say that, hey, the market won't bottom out unless interest rates stop increasing. That's not necessarily how it works. But what we can say is that bond yields historically have been a pretty good indicator we can use to understand where interest rates should be, right? And so bond yields right now are at the levels they were at. I'm using a 2-year government bond yield just as an example, are at the levels they were at in November 2018. And all we need to do is go back to interest rates and see that, hey, interest rates are actually at the level they were in at November 2018 as well. And so now what we're seeing is that interest rates aren't dramatically, quote unquote, undervalued anymore like they were earlier this year. In fact, the Fed's actually pretty much on track with interest rates in relation to bond yields. And so the way they are measuring systemic risk is lining up quite well here. And so, yeah, there is a pretty good argument to be made at this point, especially with the DXY doing what it's doing right now. Yeah, technically it's broken back up into descending wedge formation, whatever. But the point is, there is a pretty good argument to be made at this point that the macro situation is getting a lot better. And hence that is, a bit of supporting evidence there for the bulls. Now, it also could just be a bull trap. Who knows? Kind of hard to say. I'm not an economist. But I suppose, what would you say about that? Would you say that these traditional markets are looking a lot better, and hence the systemic risk is decreasing a lot? Would you say that, for example, I don't know if you have any opinions about whether inflation has topped out, what you think about that in relation to Bitcoin?
Yeah, so this is kind of what I talk about a lot on my channel, and the viewers on my channel and I talk about this a lot, particularly systematic risk, because I utilize systematic risk a lot in my macro predictions. And I think before we go ahead and talk about this, I think it's really important people understand, and I think this is a really confusing topic to people, that financial markets, particularly cryptocurrency and stocks, like you said, they usually front run economic indicators and economic news, right? That doesn't mean it particularly prices in. It just means it moves quicker and it moves faster. A lot of other economic indicators are very much real time, where financial markets react before that news is dropped, because one of the main things systematic risk is measured in financial markets is, I'm just going to go ahead and screen share of you, Wolf, 1 second. I always forget how to do it. I'm not very good on Zoom. Here we go. So you were talking about systematic risk, okay? And I guess this is the best way I can go ahead and visually represent systematic risk and how it impacts the markets. So we're talking a little bit about how the macro environment, and this is important, the macro environment for which we're talking about in regards to cryptocurrency and financial markets. So we're not talking about the housing market, we're not talking about jobs, we're not talking about all that kind of stuff. We're talking about the relevant indicators for financial markets, we're talking about that. Those seem to be getting better. And we have two things that determine systematic risk. Obviously, systematic risk is made up with inflation, it's made up with interest rates, tax policies, monetary policies, all those things that you can't control as an investor. That's kind of what the basis of systematic risk is. But we also have something called perceived systematic risk. This is really important because although the systematic risk in the last period with CPI increasing, with interest rates, inflation increasing, our perceived systematic risk in the financial markets has decreased. All right, the perceived systematic risk is what is driving the price right now upwards. People are expecting, or at least anticipating, that the macro environment, interest rates, inflation is closer to topping out, or if not topped out, then in comparison to going up. And that is all it takes for these financial markets to turn around. We don't actually need to have topped out. We don't need confirmation that we've topped out. People just need to have the perception that we are close to topping out or we have topped out, and the markets will turn around. So let's take a look at this. If systematic risk decreases, okay, which is a good thing, we have this line decreasing, okay? The beta, therefore, for cryptocurrency and stocks over here, draws outwards. If the beta increases, the return on the investment increases, okay? They move upwards. And the other way around, if systematic risk increases, this moves this way, the beta decreases, the return on the investment decreases in comparison to the risk. That's really important because the return is only return based on the risk. Okay, so the stocks and the cryptocurrency are correlated, but they're not correlated to each other. They're correlated because they're both connected to systematic risk. So as systematic risk changes, we see both of these markets move in the same direction, but by different amounts. I think that's kind of all I want to talk about there, Wolf. I think that summed it up. I think you were talking about how you think the stock market will kind of lead the way or kind of show us where the markets are going to go. I personally disagree, just because of the fact that I believe that the correlation between cryptocurrency and stocks is not high. It's only 0.7. It's not perfectly correlated. It's because it's connected to systematic risk. So if we keep an eye on systematic risk and we identify how systematic risk, the actual systematic risk is changing, and we're going to get an identification of actual systematic risk in a few days when CPI comes out. If that's lower, then we know actual systematic risk has decreased, but also perceived systematic risk. So what are people thinking? What is going on? Do people think inflation's topped out? Do people perceive the fact that the previous interest rate rise was equal to the one that preceded it or the one before it? Do people perceive that as a positive thing? If so, perceived systematic risk has decreased, and therefore we have this effect in the market where everything starts to move upwards. I think that's very important. If people are waiting for broader economic indicators to make decisions in fast-moving financial markets, they are going to be late. If you're waiting for people to say, we're in a recession, now it's time to sell, guess what? You've missed 80% of the drop. If you're waiting for people to say,
what's happened.
That's exactly what's happened. That's exactly what's happened. And if you're waiting for people to say, oh, we're not in a recession, we're healthy, the markets look good, interest rates are back down, inflation is back down, guess what? You've missed the bottom. And this is my whole idea. This is my whole analysis. This is what encompassed my whole prediction, that I predicted the fact that systematic risk was going to increase. And therefore I took action beforehand. At the bottom, I predicted the fact that systematic risk was going to decrease and took action beforehand. Again, my risk tolerance allowed me to do that. Whether some people will want to wait for a little bit more confirmation, there's nothing wrong with waiting for confirmation. I personally am just willing to take that risk. I took that risk and it's paid off. Sometimes it won't, sometimes it will.
Yeah, and I'd just like to add one more thing. I'll share my screen quickly, so I'll wait for you to. There we go. I'll add one more thing as well, because I understand people get a little bit confused about this. Now, I want to make it very, very clear. The reason why crypto topped out in November, I don't know if you agree with this, but this is certainly my opinion. The reason why crypto topped out in November is not because we were in a recession. Crypto tops out every 4 years. So it's very important to understand that, in my opinion, regardless of whether the recession happened or not, we still would have topped out and we still would have entered a bear market, right? Now, would it have gone as deep as it's gone? I don't know, probably not, right? Maybe we just bottomed out the 200 week like we usually did. Maybe we reached this macro uptrending line again. I don't know. The point is, doesn't matter where it went, we still would have had this correction. And the reason why we know that is because, as I said, the traditional markets didn't top out until January. By January, Bitcoin was already down here at like 35K, right? Very important stuff. I think people need to remember that. This isn't just a recession that's driven it downwards. Okay, yeah, recession's definitely added fuel to the fire, but this has happened naturally as per the 4-year cycle theory. And so even if Bitcoin goes here and goes upwards, yeah, the data will be skewed, but I'll still be a big believer in the 4-year cycle theory because there's no evidence to suggest that it's wrong at this point. So yeah, I don't know if you got any comments on that. Otherwise,
yeah. So
probably.
I personally, and I've made this opinion quite clear already. I personally believe that the top wasn't in November. I believe that was a false top. I believe the top of the cycle was in May. Or April, whatever it was.
So even with that said, that still wouldn't invalidate the 4-year cycle theory.
No, of course not.
It would invalidate the date range. Yeah,
it just invalidates. All it does is it changes the date range. That's all I agree with. That's all. I would say my only difference. Now, let's just do. I just want to do a quick summary for everyone who's still watching, just so we can keep up to date with what's going on. Short-term summary. Can the price continue downwards? Absolutely. The probability, however, that the price drops to a new low has significantly decreased because we've closed a weekly candle of up to 200. When will the next move be validated? The next move upwards to $26,000 to $28,000 is validated once we get a daily close of 23,800. Until then, it is rightfully, or as I would say, it's good to remain cautious and expect downtrend until that occurs.
Yep. And I think we'll look at the Crypto Academy before we end it off.
Sounds good.
Crypto Academy, I'll just jump into it right now. I'm sharing my screen. Myself and Whale created this company, Crypto Academy, earlier in this year, Q1, released the product.
What for you sharing your screen?
What was that?
Share your screen?
Yeah, I'm sharing my screen.
Oh, I can't see anything.
Let me just restart the share.
Oh, there we go. Sorry, my bad. There we go.
No worries. Let me restart the share. So yeah, we created this company, Crypto Academy, released the product in May this year. The product is Become a Trader, a 10-unit course. If you want to learn how to do objective TA, which is the only thing that's going to make you money in the market, by the way, biased TA is not going to do much for you. You're going to have to buy, well, you're not going to have to buy the course, but one of the ways you're going to do it is by buying this course. You can, of course, learn individually. I personally learned individually, but I can tell you it was a lengthy process and there was a lot of misinformation included. So if you want all the information, or at least 90% of the information, in one compact course with quizzes, slides, videos, worksheets for visual learners, verbal learners, whatever you might be, this is the place to go. And so if you're interested in that, we've got 56 students. In fact, we've got 58 students. I need to update the number. And you can go ahead and chuck us an email here at cryptoacademycourses@gmail.com, and we'll send you back a video that explains what the course looks like, what's involved in it, and also kind of like a pamphlet that does it visually as well. So it shows you photos, shows you a more extensive outline that you see on the website. So yeah, if you're interested in that, go ahead and sign up. And other than that, I reckon we'll end the video there. Thanks for watching, guys. Hope you enjoyed.
One sec, Wolf. Sorry.
No worries.
Sorry. I wanna go ahead and pop this in real quickly, because a lot of people are probably thinking, and this is about Bitcoin, of course, you know, I didn't buy 18K, I didn't buy 19K. What should I do now? What should I do now? And they're panicking. Go back to the charts, take a look. Right now, again, your entry should not occur right now. Just wait for the confirmation, because you are much higher. You're much closer to this resistance than you are to this support. Buying at resistance is never a good idea. Wait for that confirmation, wait for that break before you consider buying. If you didn't catch the bottom, or that short-term bottom, whatever it is, it was confirming bottom or not, now is not the time to revenge trade it. Don't be like, oh, I didn't catch it, I need to get in now. That's not what you should do. Just be cautious and wait for the next opportunity. That's about it. That's all I want to say. I think we'll wrap it up there. Okay. Thanks for watching, guys, and we'll catch you in the next one.
Cheers.